there a scenario where one of the parties may be required to put in more money?
Yes, there is.
I see.
If the value of your contract continues depreciating,
I see.
More than the initial margin. First of all, the variation margin.
I see.
Once we exhaust the variation margin,
yes,
we call up additional margin.
I see.
So you are required to continuously fund that position because somebody else's value is continuously improving.
I see.
You have to continuously fund it.
Yes.
So there's going to be a continuous call up. So what are clearing members doing? Because they're saying the variation margin might not be sufficient.
Yes.
Let's take an additional margin over and above variation margin.
I see.
So let's exhaust variation margin. We have an additional margin.
I see.
To help that happen. Do we envisage that scenario? It can happen.
Yes.
But what we have done in our calculations
yes,
of the initial margins,
yes,
we have taken what we consider an adequate amount,
yes,
such that even if you have to do a variation margin, it will not be overly off the market. It takes a significant event,
yes,
like maybe the underlying stock has done some major event for that movement to happen.
I see.
But that's why you need to protect, ensure that there's enough sufficient funds to allow the flow of funds to happen.
I see. So you have the NSE as a clearing house.
Yes.
You have the clearing member as a commercial banks.
Correct.
And you have the
trading members,
which are the stockbrokers and the investment banks.
Then you have the clients.
And then you have the clients.
So it's a pyramid movement. It's like that. So clearing member, trading client, trading members, clearing members,
yes,
clearing house.
And do both counterparties have to come through the same trading member?
No, not necessarily.
I see.
You can actually have one party being a different trading member and a different trading member.
I see.
And then they meet.
I see.
Yes.
And the clearing member is the
clearing member is So each trading member has signed up to a particular clearing member.
Yes.
And that's how it's structured.
So the NSE is the clearing house.
We are the clearing house.
Clearing house.
So we are the ones who guarantee we hold the initial margins.
Yes.
And also we're the ones who allow the movement of funds.
You do the balancing.
Yeah, we do the balances on a daily basis.
On a daily basis. Okay.
Yes.
Okay. Interesting.
The beauty about this contract is that your settlement is guaranteed on a daily basis.
I see.
Because we are in charge of the clearinghouse, we ensure the funds come through.
I see.
So there's no way, if you've gained, your money is there the next day.
I see.
If you've lost, your money is also lost the next day.
Yeah.
So that settlement is why we are right in the middle.
I see.
Correct.
And the contract is usually for how long?
The contracts are normally for 3 months.
3 months?
You can have 1 month contracts.
Yeah.
But ideally, most of them are 3 months.
3 months.
So it allows for markets to really play for adequate time before expiry.
Yeah.
But you can have contracts of different tenors.
I see. And is there an option for the counterparties to opt out during the contract period?
Yes, you can.
Yeah.
In fact, that's the other benefit.
Yeah.
If after a day or two I've made money,
I
can close my position.
I see.
I can tell my broker, please sell and close my position. So I'm getting out of my buy contract.
Yeah.
And I make my money.
And what does that mean for the other counterparty?
So what happens is that the other counterparty, if they're still holding the sell side, ideally somebody else has taken over that position.
I see.
You get it?
I see.
So there'll be so at least the whole structure will continue operating. But I've exited.
And do the banks play any role, like for example, temporarily holding the other side if we don't have a counterparty that is immediately available?
If there's no counterparty to take over your position, we are bringing in market makers.
Market makers.
So market makers will be firms, primarily investment banks, who will guarantee trades.
I see.
So they will be having a two-way pricing. So they'll be able to be buyers on one side and sellers on one side. So that if I want to sell, there's a guaranteed buyer.
I see.
If I want to buy, there's a guaranteed seller.
I see.
So market makers will provide that role.
And that is by the trading member?
That's by the trading members.
That's the stockbrokers and
the investment banks.
And the investment banks.
Yes. Those are going to be the primary, and that's the reason why we want them in place is so that we can guarantee liquidity.
I see.
So that the contracts don't remain static.
I see.
Yeah, you're able to always get out when you want.
I see.
And they make some money out of it.
I see.
For doing that service.
I see.
Correct.
Interesting. And are the market makers already in place, or is this something that is?
We are working on them.
Yeah.
We have interest from a couple of them.
Yeah.
And very soon we'll have them in place. Yeah.
I see.
Yeah, that's one very key component.
Yeah.
That will allow the growth of these markets.
Yeah.
Otherwise, today you must wait for a buy-lag for somebody to be on the other side.
Yeah.
So you could say, I'm closing my position.
Yeah.
You might not be able to do it today because there's nobody else ready to take it up.
Yeah.
But once you have a market maker, that guarantees you on a daily basis, somebody's going to buy you out.
I want to imagine that the market maker will have to have a certain threshold of their capital.
Yes.
Requirements.
Yes, there are requirements for firms to be market makers on capital requirements.
Yeah.
Majority of these also have to be licensed by the CMA.
Yeah.
So there's that structure.
I see.
That's working. I'd like to just draw a very simple comparison.
Yeah.
Today, if you buy Emakiba bond, when I want to sell Emakiba, there is somebody in the middle taking it out for me. If I want to buy Emakiba, there's somebody who has a bond who can sell it to me. So we've put a fund in the middle. We call them liquidity provider, and not market maker at the moment. But they guarantee a buyer to buy and guarantee a seller to sell. So that's the same structure, same kind of framework that you have for the derivatives market.
Okay. So Piers bought a contract from and Jeff sold.
Yes.
It's 90 days.
Yes.
Piers is in the money.
Yes.
Jeff is out of the money.
Yes.
So how will that be settled?
So on expiry,
To be personal, yes.
On expiry, the clearinghouse will then have identified which clients of the trading, which client is in the money and who's out of the money, and then they will close the positions. So we'll settle. That contract will expire. We'll refund the initial margins and all the variation margins. That if you've got the money, you'll get initial margin plus additional margins that came from somebody else.
I see.
If you have made a loss, then we'll find your initial margin and your residue.
Yes.
Your minus that remains.
Minus what went to
the other side. Yes.
Oh, very interesting. I think
yes.
That's a very interesting insight. Thank you, Jeff, for really breaking it down.
You're welcome.
I think for our viewers out there, so if you're interested to participate in a derivatives exchange, you've got to identify a trading member. Go to one of the 12 licensed derivatives trade members, and you'll be able to start the process and get into a contract. And hopefully, you'll be in the money. Thank you for watching.